The year 2023 has been tough for China's economy, with 460,000 companies closing down and 800 million people in debt. This economic crisis has raised questions about the future of the world's second-largest economy. How did this happen, though? And is there any way out of this situation for China? The newest World Economic Outlook report from the International Monetary Fund was released on January 31st, 2023, and it increased the projected global economic growth for 2023 from 2.7% to 2.9%. China's economy was also dramatically upgraded from the October 2017 prediction of 4.4% to 5.2%. According to Bloomberg, the IMF has increased its global economic growth projection for the first time in a year. The US and European markets' recovering demand and China's improving COVID-19 outbreak are the causes of the upward revision. According to the paper, a weaker US currency presents a better prognosis for emerging market nations with foreign debt, which also asserts that modifications in China's epidemic control policies will promote global economic growth. In developing nations' emerging markets, economic growth is anticipated to reach 4.0% in 2023. Local Chinese economists and professionals, meanwhile, are not all upbeat. 2022 is certain to be an extraordinary winter, according to Li Chun, a Hong Kong journalist for the Chinese Economic Daily, and 2023 could be even worse. Embarrassingly, he provided several numbers for the first half of 2022. 800 million people were in debt. 240 publicly traded companies were liquidated. 460,000 businesses closed. 3.1 million self-employed accounts were dissolved, and there were 460,000 enterprises closed. These statistics are consistent with the information that is circulating on the Chinese web, where it is stated that a startling 93% of brick-and-mortar stores will likely close by the middle of 2022. A list of physical brick-and-mortar store closures in 2022 was released. As of July 2022, some recognizable brands like Walmart, Louis Vuitton, and KFC were included. All you're going to hear next is terrible news. The publisher and president of Wealth Magazine, a financial news medium in Taiwan, wrote that 40,000 businesses, mostly micro and private enterprises, were closing down every day nationwide. Although high-level meetings of the Communist Party have urged major developers to guarantee the delivery of residential buildings as a key economic priority since 2023, China has been in a crisis since the mortgage suspension wave started. This crisis and alarm, however, have not subsided, and an increasing number of ordinary Chinese people are now learning what it's like to have to pay back $4,886 per month on a mortgage in 90 months. According to a recent article in the Chinese media, China Business Network, many defaulting real estate corporations issue new bonds. The list of those receiving financial assistance is growing. This headline also amply illustrates China's real estate crisis. We have previously covered China's dubious real estate economic development model. To summarize, China's real estate sector is currently experiencing a crisis due to a declining demographic dividend, slow population growth, and an oversupply of properties. Is there any demand for all the residential buildings that fill this country? There is no money in the purses of Chinese real estate developers, home-buying families, and local governments. And it's challenging to borrow money to buy homes because of the pressure from inflation, which many private enterprises cannot afford to pay. This situation is now getting worse due to upstream firms leaving many dilapidated tall buildings. First, the new coronavirus has infected over 900 million people in China, causing deaths in excess and damage to the medical system. These factors will affect China's social stability and purchasing power recovery in 2023. China's policies are shaky. Cities closed and subsequently reopened without government intervention. During platform economy crackdowns, it is screamed, "Share prosperity." Real estate, education, and training now all go hand in hand. After the National People's Congress in March 2023, Li Xiang will become Xi Jinping's premier. Investors fear policy uncertainty. So far, the Chinese government's 2023 economic development plan is to expand consumption and invest. The biggest challenge with growing consumption is that Chinese consumers will hang on to their money even more due to economic micromanagement and policy management compared to prior Chinese premiers. It has raised China's economic instability and made company investment harder to resume. Comparing deposits over the past 4 years, we can observe that the sector has surged to $2.64 trillion from $1.47 trillion in 2021, $1.67 trillion in 2020, $1.44 trillion in 2019, and $1.7 trillion in 2018. By raising the fiscal deficit and issuing massive amounts of domestic scrip, the communist authorities can't resist the international trend in 2023 investment. Two more concerns would prevent investment from driving China's economic growth. First, China's rapid industrialization and urbanization are complete, and some economists warn that artificial investment may not build productivity capacity or actual public services. This will waste financial material and human capital. Second, how big will the 2023 pandemic be? The CCP is betting that everyone will contract the virus and gain herd immunity to survive. But the present outbreak has killed many people, and that outlook is dismal. And what if the CCP predictions were wrong? Hope you enjoyed the video. Please leave your thoughts in the comments below. If you enjoyed this video, be sure to like, subscribe, and turn on the notifications before leaving. Thanks for watching, and we'll see you in the next one.